to follow. Anyway, we are, this is the New York Fire Department Pension Fund Investment Meeting. Today is 5/16. It is 2 minutes after 10. We have the Controller's Office, 1 Center Street, room 530, New York, New York. We need a roll call of trustees, please.
Roll call of trustees. Ms. Ranji Nagaswamy.
Here.
Mr. Larry Schloss.
Present.
Ms. Janice Emery. Present. Cassidy.
Mr. Slevin is Mr. Cassidy's proxy.
And Mr. James Levin.
Present.
Mr. Robert Straub.
Present.
Mr. John Kelly.
Mr. Straub has Mr. Kelly's proxy until he gets in.
Mr. James McGowan.
Patrick Dunn for James McGowan's proxy.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Present.
Mr. Sean O'Connor. Commissioner White.
Present.
We'll have 23.5 votes in a quorum. We can start the meeting.
Okay, we'll start with the public agenda. Larry?
Okay. Let's go through the monthly numbers. Everybody have one of these? Color? Okay. So I guess the simplest way to say what's going on is actually on page 2. And that's the GDP. You can start to see it's basically slowly starting to slow down. There's a lot of talk in the markets about slowdown and what's going to happen. Fundamentally, I think the general consensus is the economy got to 3.5%. It's going to stay there a little bit south for the next quarter or two, which is not very good.
I'm sorry, can you speak up, please?
Yeah. It's not very good for as far as reducing unemployment. You need numbers north of 3.5% to get the unemployment rate down. So the economy is going to muddle for a while. That said, if you go to page 3, you can see capacity utilization is going up, which is good. You can also see on page 5, unemployment claims are trending down, but they go up and down on a monthly and a weekly basis. So I can't explain to you the particular spike that you have there. But again, it is trending down, but ever so slowly, as you can see on page 6. The unemployment rates went back up. It was down to 8.6. It's back up to 9 again. This is going to be a problem for the foreseeable future. On page 7, you can see the dip in March. The dip in March is a result of the tsunami and earthquake in Japan, as well as political upheaval in northern Africa and the Middle East. Something to watch is on page 8. Page 8 is architectural billings. Remember that you hire an architect before you build a building. So this is one of the few leading indicators that we track. And to the extent that it levels off or goes down, that's not good. Again, architects are easy to fire without spending the money to build a building. So again, it's easier to stop as opposed to once you start with actual construction. Next page. Existing home sales, again, low level. Foreclosures continue, and the nettest effect of foreclosing is the next page, which is page 10, which is new home construction, because the overhang is a result of unsold.
I'm sorry, because the
Overhang of unsold homes. It's keeping pressure on prices. Home prices going down, and no need to build a new house. Next page is retail sales. Again, I can't explain to you the spike. I think it's just a mathematical error, but I'm sure, confident it'll come back down to around 3.5%. Auto sales are going up a little bit. Again, everything sort of plateaued a little bit in March. Again, the tsunami and what was going on. Auto sales are trending up again as well. Zero interest loans for auto sales are what's pushing some of that. 13 is leading economic indicators. So when you add it all up, it's going up again. The trend is the most relevant number. A dark cloud on the horizon is the inflation. You can see the CPI. The CPI includes energy and food prices. The Fed's not as worried as some other people in the press, but everyone is watching inflation. Inflation ultimately kicks its way through interest rates, and that'll be a big mess if that was to continue to increase. Page 16, you can see how it manifests itself into the dollar. This is the dollar versus the euro. It has since corrected. You can just see the beginning of it in the last line. It's now down to about $1.4 to a dollar. This has a variety of implications. You can see on the next page, page 17, a weak dollar is good for exports. It's not good for stores of value, which is why gold, for instance, is going up as the dollar goes down. Next page is LIBOR. You can see that's pretty much flat. That's a good thing. That means it's flat at a low level is a good thing. It means European banks are comfortable lending amongst themselves. The VIX is at a very low level. The VIX, as you know, is a volatility measure. I expect it to go up a little bit at some point in the near future because there's a lot of things out there that the market is severely discounting. Page 20. The simplest thing to look at, the white line is the current Treasury yield curve, but what's interesting is I guess it's yellow line is year end, and actually not much has changed. A lot of ups and downs in the middle, but not that much has changed. You can see, however, at the very, very beginning, the 1 year, the shorter end, continues to go down. Again, the worry that's not in the VIX, but is out there, is making short-term rates go down. You can see some of that as it rolls through the Treasury curve on the next page, 21.
See some of that.
On the next page, page 21. Sorry, I'll talk slower. Is the 10-year rate, which had sort of hovered around 3.5%, is now down or below 3.20. Again, there's a certain amount of fear out there, but we'll talk about that a little later, perhaps. Spreads, people looking for risk, continue to compress. As you know, we sold some high-yield bonds, which is the yellow line as spreads compress. As people reach for risk and for yield. The next page, 23, you can see the stock market values of U.S., emerging markets, and IFA, all of which are on a historical basis not that expensive. You can also see it on page 24, the multiples of the large, mid-cap, and small-cap. Most interesting chart is 25. It's the stock markets, and again, if you just look at March, which is the dip, again, these are March numbers. So we went into March and things were doing pretty well. Things were trending up. The tsunami hit. But the most interesting thing is that if you look at the April number, it all passed. So there were 2 weeks of lots of commotion in the markets. But now if you look at April and if you even extend it through to May, the markets are up again, which I'll show you what that meant to us in a second. Page 26, M&A activity is picking up. That's good. Corporations have a lot of cash on their balance sheets. CEOs are confident in their futures, therefore they buy other businesses. Page 27 shows you Fire's value. It's at another all-time high, $7.9 billion. I'm optimistic it crosses 8 in the near future. Stay tuned. And you can see on page 28 how it's done basically in the last 12 months. So we're up about $1 billion, a little trip down, but we're up $1 billion, which is terrific performance. On page 9, you can see the asset allocation. We're basically a little under-allocated all the fixed income, a little over-allocated emerging markets, and U.S. equities were under-allocated, as you know, in real estate, so that's down. We'll do a little bit of rebalancing probably in next month as well. If you look on page 31, on the left-hand side, you can see despite all the volatility in March, because remember it went down and back up, we still made 1%. And if you look at the third column, the fiscal year to date, we're up about 22%, which is terrific. And if you go look at the 3-year number, which includes the complete debacle in 2008, we're up 4%. So all is good. And what was bad has been fully digested, and now we're back to more longer-term numbers. If you look in the 1-month number, where do we make our money? It was in the U.S. stock market and in, can't quite tell you what the green is. I don't think so. All right, let's go to emerging markets. I'm not quite sure that's what it is. But, my mistake. Is it emerging markets? All right, emerging markets. So again, the equities bounced back. Fixed income hasn't really helped us very much because of where the markets are. If you look on 32, again, the first column on the left, you can see what I was talking about. The top part, again, of the U.S. markets, basically no runs, no hits, no errors. About the same thing when you run your eyes all the way down. If I give you a preview of next month, which is April, and you turn the page, you'll see that people reacted to the calm after the tsunami and heavily discounted what's going on in the Middle East, and the markets were up basically 3% plus or minus, as were the bond markets. So I would expect April to be another good month. Since we're going to do a quarterly next month, we'll talk more about the managers then. Again, in general, the managers performed.
I'm sorry,
In general, the managers performed in aggregate within expectations. So I won't go through any of these managers in particular. Again, we're up about 21% for the year, and things are going pretty much as expected. The biggest change that's coming in the future is the Fed is going to end QE2. That's starting to get discounted into the markets. I'm not quite sure what it really means, particularly with the economy slowly weakening. You'll also see some turbulence in the press about the government hitting the debt ceiling. I presume all that gets passed because we're not going to default on our bonds. So I would think that the next month or two is pretty calm, with pangs of anxiety in the interim. I'd like to think between now and the end of the fiscal year, nothing happens and we end up with a very robust fiscal year.
No, no, for the record, Goldrich, is now in attendance at the meeting.
That ends the review of the monthly numbers. You all received a BAMogram, I think it was Thursday, that said we've launched this new RFP for emerging markets. Remember, we're using this new process, the innovative procurement process. This is the first test case of it. It relies much more heavily on our consultants throughout the systems.
On our
Consultants throughout the systems. It's on purpose, since it's the first one, it'll be a little slower than probably the last one, which we'll see exactly how fast we can race the car. But again, since it's emerging market managers, it's a global search. It's the perfect test case to see the outreach that our consultants have. With that, let me hand it over to Seema, talk about emerging managers. Yep.
Mark passing out the color copy version.
I'm sorry.
Mark is passing out the color copy version.
I got it.
So you might remember that we did discuss wanting to issue a new RFP for the Emerging Managers Program. And that was in light of our terminating Vivium last year, as well as Lombardia, who's a developing manager. And so, sure, Lombardia, who is a developing manager. And so we wanted to just, in these slides, provide you with some background and talk through some of our suggestions as we move forward. So if you turn to slide 2, a little bit of background, emerging managers, who are they? These folks are generally too small to be standalone mandates for New York City. Fire has elected to invest in these emerging managers through what we're calling a fund of funds program. These are emerging manager of managers. And those folks are monitoring these underlying smaller managers on a regular basis in terms of performance, organizational issues, and the like. And they're updating us on a regular basis as well. One thing to note here is that these sub-managers, historically in New York City, we've defined them as those managers who are $1 billion or less in firm-wide assets under management. If you look at slide 3, this is a little history here. December 1998 was when Fire first invested $50 million in this type of program with Progress. In 2007, along with some of the other systems, they invested $108 million with 3 other managers of managers. And at that time, that investment represented about 7% of active U.S. equities and over 1% of your total assets. The 3 manager of managers are listed below with the allocation amounts. If you turn to slide
7% of what?
of your active U.S. equity assets. If you turn to slide 4, this shows you where we are now. So as of March 31st of this year, you see the 3 manager of managers listed below in which Fire is invested, and the dollar amounts over $100 million in total. And right now, that amount equals 13% of your total active U.S. equities. So that's up from 7% when you first started. And the percent of total assets you see there is close to 1.4%. The next slide 5 shows the performance through time of these emerging manager and managers, and we show you numbers here on a 1-year, 3-year, and 5-year basis, as well as since inception, or since 2001. So if you look, I ask you to look at the bottom row here, 2010, and scroll across to a column closer to the right. So you'll see excess return since 2001. And you'll notice it's a slightly negative number, and that's net of fees. As of March 31st, that number is more like down 9% relative net of fees.
9 basis points.
No, sorry, 9 basis points. Sorry about that. And one issue to note here is that the Fire program, the benchmark is the Russell 3000. These are all cap products. Some of the other systems have had Russell 2000 products, and those funds have actually performed better than the all-cap products have. So I just want to make that point in case you're looking at comparisons across different products. Fire has only had all-cap manager or managers in their portfolio. So if you look at the final slide here, then on slide 6, a couple of recommendations as we think about policy, as we think about issuing this RFP. So one, we would recommend that we move forward and issue an RFP for emerging manager or managers. Last time around, we had about 12 responses. We think this time around we could have anywhere from 15 to 20 responses. So we really want to broaden out the universe here and providing more opportunities for emerging manager or managers, many of whom are minority and women-owned businesses. And so we'd like to do that and move forward with that. But as we do that, we're going to be putting together a scope. And Ranji, we know, has had several questions, Ranji and Janice, and we've talked about those at some of the other systems. And we're going to be answering those questions through the process of writing the scope. And I don't know if you wanted to raise a few of these, but some of them are around the overall structure of our program. So to date, one of our recommendations here on page 6 is that we increase how we define an emerging manager or manager. So right now it says that once you get to $1 billion, you now can so-called graduate out of the program and become a developing manager. We think that number is quite low. We've had conversations with NEPC about this as well, and also the emerging manager or managers in your portfolio. And so we'd like to move that number up to $2 billion in terms of firm-wide assets under management. As part of that, that's an ongoing conversation that we've been having. We feel comfortable with that. We have some data to support moving that number up. But importantly right now, contractually, once a manager gets to over $1 billion, New York City doesn't have contracts individually with the underlying managers. We have contracts with the emerging manager or managers, the fund of funds manager. So if we wanted to graduate someone, the only way to do that really is to issue a new RFP. Otherwise, they stay within the portfolio. We don't necessarily kick them out, but it's possible that we'd have to figure out what to do with them. We'd like for them to graduate. That would be the whole idea of the program. So, and we wouldn't want to penalize the fund of funds manager either as we consider graduating them, and now they're left with a bit of a hole. So we'd like to think about restructuring these types of contracts and allow for us to be able to just graduate a manager and then kind of reward the fund of funds manager in a sense for having graduated a great manager that we like. So these are some of the conversations that we'll continue to have as we write the scope. But what we'd like to do, though, is go ahead and issue the RFP and get your vote on that.
So our questions, as Seema pointed out, have really been about has this program worked and what parts of the program have worked. As Seema pointed out, the small cap has worked a lot better. All cap hasn't outperformed the benchmarks. So what benchmarks do emerging managers more systematically outperform? So we want to be sure that we address in this all of the policy issues that come up when you have a chance to go out and find a whole new group of managers to manage the entire program. That means going back and understanding what has or has not worked within the program. If we find that, just like in everywhere else, having a Russell 3000 doesn't work, all cap doesn't work, but small cap works or international works, let's target those places for this program. Fixed income, my worry about $2 billion is I don't think $2 billion is scale in fixed income. So to have one size fits all for going from $1 billion to $2 billion, does that make sense? So I think it's just a good time for us to sit down and just think through what has worked, where is the universe developed, and what Seema has said is some of this will depend on going into the market and seeing what BAM finds in terms of who are the managers. The space has changed a lot. That's a very valid point. So I think as a board we should be open to BAM coming back on, but we would like to see a broad variety of policy issues addressed.
Well, a bunch of policy issues there's before you issue the RFP, then there's during the RFP, then there's the managers. So
Before you issue the RFP?
Before you issue the RFP, during the RFP, and then who you select. And since the RFP process for this, since it is a fund of funds, it won't use the new process because the new process is really with the consultants is for managers directly. This will take the more normal, more slower approach of, I don't know, probably take us 4 or 5 months to sort this out, during which time we'll answer all the questions and get it all put together right. So,
Well, it seems like the RFP is a fact-finding mission for both the consultant and for us.
yeah.
Right?
I'm sorry,
So,
the RFP is a...
fact-finding mission about what has happened in this space since we last looked for something to manage. So
That's right.
it doesn't feel like NEPC or BAM has answered right now to who's in this space, what works, what doesn't work. So I think collectively to issue the RFPs to go find out, but then come back to the boards with fact findings. Even sort of, I'm just thinking, even sort of specifying the scope, I think we can have a summary or a draft, but not a final until we actually get some market knowledge back, right? That almost seems...
Well, I think we can issue the scope based around minimum requirements that we're comfortable with and based around a policy that we would all collectively agree on. So I think at a minimum we can do that, which is what a scope really does do. It sort of defines in general terms what we're looking for. And I think we do have a good sense over what size and the performance metrics that we consider, and the sense that we'd like to try to set up contracts directly with you if you do very well for us.
Right.
So I think all of our intentions that way we can put in a scope, and I think that would be sufficient.
So that I misspoke. I think the final policy should not be
Right.
set till we go through
Absolutely.
the
That's
process.
right. That's right.
That's right.
Yeah.
And then my second point had been the point that Seema mentioned, which is I'm a little concerned that managers actually succeed in this program, meaning they graduate from the emerging managers, and our contracting doesn't allow us to keep up right when they've done exactly what we asked them to keep. So I hope we'll keep pushing on that front with the contracts and how we write them, because it makes no sense to me that a manager who graduates from emerging managers cannot show up in our developing managers and we have to start all over again with an RFP. That makes no sense to me.
Right.
Are we increasing the amount of investment in this asset class?
Yes, we would consider doing that also, depending on.
We're doing an RFP,
the
we're going
managers
to bring in a lot of new faces. If we're not going to replace the 3 we have, what's the real purpose of the RFP?
Yeah, sorry, if we're not going to replace?
Yeah, if we're not going to replace one of
Well,
the 3.
all of the 3 that you currently have will rebid. And then we would expect that there will be others out there that could be very competitive that we'd like to add potentially to your portfolio. We would come back with a recommendation like that.
Okay.
John, there's also one of the other funds in the system has IFA managers. You know, the fire department doesn't. So maybe there's an emerging managers of international that we could add to the list. But to do that, you have to have the RFP. And Ranji points out that, again, the other system also has one for fixed income. Maybe the $2 billion is the right number, who knows? But again, fire doesn't have that either. So it's kind of an opportunity to look at the whole program, recalibrate it, and see if there's other sub-asset classes to have it in, and then make a decision once we really have a better understanding of what's out there. A lot's changed since the last time we did this.
And also, just one quick point, John, is that Lombardia for you is $33 million. They're a developing manager, but Lombardia for you was $33 million in the portfolio. And they're a developing manager, but they were a good graduate candidate. And so again, that would be nice to be able to supplement back into the fire portfolio a new manager.
As we increase the assets under management by these manager of managers, it's an all-cap fund. Are we tracking the diversification within these funds to ensure that we remain properly diversified?
Yeah, so that's one of the things that we do with the emerging manager and managers. So all the fund of funds sit down with us, or we're on a call with them every month.
Monthly?
And quarterly, we're also reviewing the portfolio. And they're often rebalancing in the portfolio itself. When either they have an underlying manager that they're not happy with, given performance or organizational issues, they'll relay that to us. They'll say, are you good with this if we shift money out of here and put it over there? So let's see how that rebalance looks, and let's look at the new portfolio and see how that is made up. And are we all comfortable? Okay, let's go do it. So that's an ongoing process.
And as far as increasing the assets under the management with manager of managers, has there been any analysis for any potential impact on like asset bloat, how it may relate to performance by increasing the amount under management by these managers?
Right, so that would depend on the strategy. So if it's a small cap manager, yes, absolutely, they get to a certain size, and then you have to wonder how is that impacting performance, mostly negatively. But then you've got mid-cap managers that have lots of room, and large-cap managers have even more room, and so it does depend on the strategy. But for this program that Fire had voted on, it's an all-cap portfolio, so there really is lots of capacity in that type of strategy. But we would be much more critical when we got to the smaller cap managers. Sure.
So Seema, you need a motion to issue the RFP for emerging manager management?
I'm sorry, Morgan, I'm sorry.
Do you want to hear from any thoughts?
Sure.
Yeah, I think that this is a great
I'm
idea.
sorry, you are again?
Kristen Finney-Cook from NEPC. NEPC would concur. We think it's a great opportunity to look at the sort of the strategies within it. Russell 3000 is oftentimes not the area where you can extrapolate as much alpha. And so
As much?
alpha. Sorry. And with that said, even the existing managers, depending on what we decide or the staff decides, fund decides the scope is going to be and the strategies that are going to be employed, even the current managers potentially can have capabilities in those areas. So I think that there's a lot here, both from on the domestic side, and then you talked about the international side as well. This area has been rapidly changing, and their capabilities, I think, have expanded greatly from 4 to 5 years ago. So we are very much in support of going back and looking at this and developing further sort of sub-policies within the larger policy to address where you might be able to gain the best benefit from these managers.
So I was just mentioning that we'd like to have a motion to allow the Controller's Office to issue an RFP for the Emerging Manager of Managers program.
Make a motion to issue the RFP for Emerging Manager Program.
Second.
I'm sorry, you were slow.
James Sludge.
Second.
Any objections? Hearing none, the motion passes.
Thank you. Now for the most interesting topic of every pension fund, that's asset allocation. As you all know, we've been working on this since last summer, and BAM has been, we gave a presentation, I guess it was last meeting. Sorry. We gave a presentation last meeting. I think it was last meeting. Was it last meeting?
It was in the February meeting?
In the February meeting, we gave a preliminary view on asset allocation. And since that time, we've been working with NEPC to refine it so that we have more refined recommendation on asset allocation that NEPC is going to walk us through.
Sure. Turn to page 11. The first several pages really just talk about assumptions as well as what we're seeing in the market. What we're seeing in the market. Is that good? Okay. So unless you have any questions there, I'd like to just jump to page 11.
1 second. It's page 60 in your book.
Right.
60.
Yeah, and
70?
so 7. I jumped to page 70.
Sorry.
No, but I was looking at the wrong numbers, so that is
What page would you like us on?
Page 70.
Okay.
So really, this just outlines a little bit of what we've been doing thus far. As you know, coming up with the appropriate asset allocation takes a bit of time and a bit of work, and so we've been working through this process over time. And really, the theme remains the same, where we're looking to reduce the equity risk on the portfolio in an effort to reduce the risk as well as increase returns. Obviously, we do still have the basket constraints in place. And as Larry mentioned, in February, we went through a detailed presentation that talked about a lot of various proposals. With that being said, it was requested that we come back and look a little bit more and tweak some of these presentations, or excuse me, these mixes. And so, especially after having the presentations from Bridgewater and GMO, we felt that this would be an appropriate time to continue this discussion. If you turn to page 71, and what you see here again is with the recommended policy mixes with the 25% max basket. You see your current policy on the left, and our recommended policy, which is mix D, all the way on the right. And some of the differences of this from the previous presentation that we did in February was we did add a bit more to tips, as well as opportunistic fixed income in emerging markets. We're going to be talking about that a little bit. So again, on the bottom, you see where the expected return goes from a 6.9% over to a 7.2%, which is a slight increase, with the expected risk of the portfolio going down from 12.8%, and if you follow Ariel's all the way across to mix D, to 12%. So we think that this is value add. It gets us part of the way. Obviously, for us to get the full way, we still have to address the basket. We also added a chance of loss. So 10% loss in year one. And so when you look at your current policy, you have a 9.4%. And the mixed D, which is what we are recommending, goes to 7.6%. So again, we think that that is a more efficient portfolio given the constraints that you presently have. Are there any questions? If you turn to page 13, because we want to also talk about, we're not here yet, but just talk a little bit about where we'd like to go, which is mixed G. That would be with discussions and the basket being increased. And so here we're taking that, and mixed G is the last column, we're taking that expected return up a bit more to 7.4%, with the expected risk going down even more significantly to 11.5%. And your chance of loss, which I think is very important, is down to 6.5%. Again, we feel that that is an even more efficient portfolio. We understand that this is a stair-step process because we do have the constraints as it relates to the basket. But we did want to project out where we are potentially thinking on a go-forward basis.
How are we defining illiquid in here, and how does this...
I'm sorry?
How are we defining illiquid asset classes in here, and how does this mixed D change that?
Sure. When you look at the illiquid, we're looking at private equity as being illiquid. We're looking at private real estate as being illiquid. So you can't get out them. They're not marketable securities. We are also looking at hedge funds having a portion of that being illiquid in our assumptions, about 50%. And as it relates to where we are currently, your current policy has an illiquidity of about 10.75%. And mixed D has an illiquidity of about 17%. So,
but mixed D does not include anything in the opportunistic as a liquid. Larry, we talked about half the opportunistic.
Yeah, I'd say either half or a third for just planning purposes,
okay.
something like that. So call, if you round that to a half, you're probably you might be about right at a half. I think half on the hedge funds, once it's fully invested, is probably too high, but for planning purposes, both at about half seems like the right way to look at risk of illiquidity. And since they're both about 5%, if you took half of 2 plus 2 5s, you'll get to about 5%. So if you add the 5 to the hedge, to the private equity and the real estate, you get to about 17.
So that's with the half of the opportunistic.
Half of
17.
opportunity. Yeah.
And we would be doing a full liquidity stuff. So that's kind of a quick and dirty. A quick and dirty sort of assessment that we just did, but we do actually do a full liquidity analysis that we have not done as of yet.
I can follow up on that. That illiquidity, I think, is a reasonable estimate of illiquidity in normal markets. Would you also be doing a stress test type of illiquidity for what we had back in the beginning of late 2008 and 9, where a good portion of Core Plus 5 was effectively illiquid? I mean, you could sell it, but you couldn't get any money for it.
Your high yield was illiquid too.
Right.
Everything was illiquid.
Just about everything in some categories turned to illiquid, what normally were liquid markets.
Absolutely. That is really the purpose of the liquidity study, is to stress test so that you have a comfort around at least the risks that you're going to be taking with said portfolio that you're either choosing, or you can have comparisons. So that is something that is forthcoming. But to answer Ranji's question sort of quickly in a quick and dirty answer, we wanted to give you a feel for where you are. That will also give you an understanding, given sort of what your liabilities and your cash flows out, how far you can be on the liquidity spectrum, illiquidity spectrum before you have a problem. Okay, so that is also what would come out of that study.
One of the things that was just mentioned is we have a 25% basket case and a 35% basket case. We currently have about 9% left in the basket, but we're going to be working to fill that out, and at our office, working hopefully with all of the constituents involved next next, what do you call the sessions?
Legislative session.
Clearly not of this. The next legislative session, we'll all get our act together and go to Albany and change this. We've had some preliminary conversations with our sister pension funds, New York Common and New York Teachers, but very, very preliminary. They also have their own different reasons to want to change the basket clause. But we'll be working again with all the constituents. Once we get through the asset allocation amongst ourselves, given that it's pretty close to the end of this current legislative session, we'll get ourselves organized and do it next legislative session. And during that period, we'll take Fire's 9% room and basket and walk it closer to the... We'll take Fire's 9% remaining basket and walk it up closer to the 25% basket. We clearly won't reach it during the next 12 months or so, but as we get closer to it, the move from a 25% basket to a 35% basket will become more relevant. And as you know, in the back of each of these monthly packages, it shows you precisely how much room there is in the basket. So, but the key is the bigger the basket, the more the different types of asset classes we can have, and therefore the more diversification. So there is a method to the need to change the basket, which hopefully will get done next legislative session.
If you turn to page 14, really this just gives you sort of a summary of what we've talked about, and Mix D, what the actual incremental changes were. We did increase private equity from 5 to 7%. We think that there's value around that, despite the fact that it isn't a liquid asset. It is value around that change. Despite the fact that it is a liquid asset, we are looking to try to add alpha to the portfolio while we balance the beta piece.
Now, is that incremental dollars, or are we already there and we're just calling our,
Which, the private equity?
Yeah,
Yeah, we're already there.
we're already there, right?
We're already close enough to it.
So it's still a restructuring to get the right managers.
Yes.
Right.
We're still going to have to do restructuring, and yes.
What is it that needs to be done legislatively?
What we want to do, John, is, as Larry pointed out next session, change the retirement social security law from the current 25% basket, which was done in 2006, and seek a 35% basket. And as Larry said, that would indicate a number of stakeholders, obviously trustees, our sister funds, because all of the 8 pension funds in the state work off that same legal list construct.
Okay, thank you.
John, some of it is it's just really dated. So anything over 10% in developed equities outside the U.S. goes into the basket clause. Now, that actually is going to become moot because we're going to take non-U.S. developed equities down. But today, if we have 15% non-U.S. developed, if we have 15% in non-U.S. IFA developed equities, 5% of it goes into the basket clause. And I could argue with anybody that G7 developed equities are not riskier. They're about as risky as U.S. equities. So God knows when this law was written, non-U.S. developed was sort of how we think of emerging markets. A lot riskier. We don't know it. So a lot of time has gone by. Markets have become more liquid. So some of it is just dated. Some of it is to allow us to diversify the portfolio more meaningfully from a risk perspective.
And back to when they were still selling railroad bonds.
There you go.
If you read the law, it actually talks about tunnel bonds. That just gives you an idea of how old.
I'm sorry, your name again?
It talks about tunnel bonds. Martin, yes.
Thank you.
But to add on to Ranji's point, while you are allowed 10% non-U.S. equity, you're not allowed anything in non-U.S. fixed income with some exceptions, or small exceptions. So non-U.S. fixed income, we don't see in the portfolio because it's basket. Bank loans, which are senior in the capital structure.
Bank loans, which
are senior in the capital structure. And in bad times, we'd rather own a senior claim on assets than a high-yield bond, which is junior to that. High-yield bonds are allowed, but bank loans are not. So there are some things that just don't quite make sense in the context of asset allocation, how we live in the world.
Hey, Ted, what would be the timing if the state really gets to the state and we get the Rob Goldrich?
What would be the time?
What would be the timing of changing the basket clause law at the state level? What's the process for that, and when do you guys expect it to happen?
We'll be doing some of the, what I call legwork, if we go into June and July. The session starts in January, so hopefully by that point, you may see something in print. But I would say that we would use the summer and perhaps the early part of the fall to do the legwork.
I wouldn't rule out some sort of special session in the fall or something, too, if we had some sort of draft ready to go, to take advantage of any special sessions that may pop up. We could all lobby together on that issue.
You all know this better than I do, for sure, but there's first get the city organized. The city, which is, the controller's office, the mayor's office, and all the requisite unions, but then there's also unions, other constituents, and the unions. But then there's also New York State teachers, New York State Commons, so that it's one omnibus change. Because again, they come at, some of these funds they're just set up differently. I know, for instance, New York State teachers bumps into the real estate limitation a lot because they like a lot of real estate. I think they're 12, 13% of their portfolio is real estate. So they have a different spin on the basket, but it's the same fundamental. The 25% is too tight. So once we get the city organized, we'll sit down with the other constituents, the comment, which is really the Annapolis people, and then we'll write the bill and then be ready. So it's probably a summer, fall exercise, right? Yeah. And that'll be our point man on it.
I want to note for the record, I'm not done so, that Christopher Barrett of the Marine Pilots is present now.
Are there any other questions? As I mentioned, on page 14, we really summarize the changes, and I think ultimately what we're trying to do is to diversify the portfolio, not just from an asset class standpoint, but from a risk contribution standpoint.
We just want to also just say, if it does go to 35%, and the state, and we're all successful on that, would mixed G be our preferred? Is that what would be the preferred?
Yeah, we'd be looking to go to this.
So my hope is that we have that long-term asset allocation conversation and run the 35% mixes based on equilibrium. Based on the equilibrium returns, on long-term returns, I think. And even if we come back to that page, we're coming back to it in several months, so I think we will have a lot more thinking that has gone into building a long-term policy portfolio between now and then. And I'd like to come back to that conversation at the end of this discussion anyway.
Yeah, I think one of the things that, this is the path that we're embarking on, right? And we're trying to make sure we get the short-term path, which is the 25% basket. We'll kind of show you where we're going, which is the 35% basket. You can't get past the 25 without the law changing. The assumptions that are in here are based on today's markets. By the time you get past the 25, the markets will be completely different, my guess is. As will the assumptions. And so we're not really buying into this whole package today. We're really buying into what I'll call step one, which is the 25% basket, which we will be working to fill on our way to the next stop, which is the 35% basket, when we have new assumptions, new asset mixes, new conversation. Or continued conversation is a better way to look at it.
And with that will be, at the bottom, it talks about alternate ways to measure risk. So that comes back to methods or ways to measure risk. And that comes back to the conversation that we just had about the liquidity analysis, risk budgeting, as well as scenario analysis, all looking at how the said portfolio or said options of portfolios that we're looking at as we're comparing will be able to withstand markets such that we had several years ago. So there would be less surprises. Obviously, we don't have a crystal ball, but to the degree that we can have some idea if everything goes down and there's no liquidity in the market, even in fixed income, where does that put the portfolio? So.
Forgive me if I was in this last month's meeting, and this may have been discussed, but it appears that the recommendation is to choose something that has a basket clause that exceeds the legal limit at the present time. It would seem to me as a minimum that if such a policy were adopted, it should be adopted tentative on the expansion of the clause, or something else should be adopted that's within the boundary. The same thing on the 35%. It appears that Mixed G would have an asset allocation to the basket in excess of the legal limit of 35%. In addition to the fact that markets move around, and there probably ought to be some, maybe it's 30%, 32%, something for expected standard deviation, it would seem to me that if the law is the law and the insurance department's going to watch it, it's probably something that just, whatever is done, ought to be very, very carefully done, and if it's going to be proposed to go close to the limit or over the limit, that it be adopted as a tentative target or whatever with something on the record showing that there's no intention to violate the law here.
I would second all of that, and the nuance I would add to that is I spent some time looking at Mixed C, and the only thing about it is that it would be better not to max out in the illiquids rather than try and cut something from emerging markets, for example.
Why are they trying to?
Cut something out of emerging markets. So the larger point Bob is making is it doesn't make sense to bump right up to the 25, even if opportunistic and hedge funds take time. And we can kind of watch because Bob we're going from 0 to 5 on hedge funds. It's a well-advertised 2 to 3 year process, so I feel like the portfolio won't bump against it. But maybe the smarter thing to do is to just adjust knowing that we're not going to get there, not take it out of emerging markets, but reduce the illiquid hedge fund that'll just take longer to build up anyway, if you see the point I'm making.
Yeah, so Doug Mosley from NEC. I think when we went through this, we have a lot of assumptions about implementation, how much of the basket will hit from TIPS and from high yield, and now we have global REITs on the table. So I think, we'd be fine if you said you want to adjust, like you're indicating, either hedge funds or even emerging markets by 0.5% or hedge funds, I think.
Only because we're not going to get invested that fast anyway.
But it's going to be a multi-year process to get to the new policy D.
No, I fully understood that.
Okay.
It will take time to use up the basket, there's no question about it, but I think if you're writing an investment policy statement that has in it something that would appear to be in violation of existing law, even if it takes a long time to get there, some caveat wording or something to indicate this is optimal if the conditions are right, but not just write it down as the policy. We know it'll take a long time to get there, but you don't want something, the Corp Council may not care, but I know the insurance department does. Oh, you do care.
Yeah, I think everyone cares. It's just there's a lot of different assumptions we have to deal with.
I'd also like to point out that the assumptions that we made were very conservative, meaning that we put more in the basket than may actually go in there. For instance, an opportunistic fixed income and hedge funds, we put the entire allocation in the basket, but the reality is not all of it will go in there. Private equity, we put all of it in the basket. The reality is we do own some publicly traded securities. So we did put some buffering and some conservative estimates in there to deal with that.
And there might be sufficient to take care of it.
On the face of it, we'd like not to have a penalty flag in your asset allocation because it looks like you breached it. Or it looks like you had the intent to breach it. So there's no need to do that. But again, there's an awful lot of specificity here, which is making art look like science, right? The answer is somewhere between reality, right?
I don't disagree with you. I'm just suggesting that there be some sensitivity to what is actually written down and intended to be accomplished, recognizing both the variability of markets may not be trying to get to the target precise, the fact that what is going to be in the basket clause and not within anything is not precise, but that it be thought through very, very carefully, and that the numbers that go down be the best that can be, and that they fit well within the legal structure.
So let's duly note it, and we'll.
I'm sorry?
Duly note it, and we will work, because I think the real answer is somewhere between C and C. So the question is, do we want to come back with the numbers, or just work with staff to create
where it doesn't, to your point, appear
To create.
we don't create or appear to be that we're going over or in some sort of violation. So I don't know.
Well, the board should, we should be clear about what we're voting on.
Sure.
So whether we do it via memo or otherwise, or
Okay.
email. But I did still have some questions within
Sure.
some of these. And the question really is about valuation. So we are actually, if you look just within the equity bucket, there is a very significant shift. We have from developed into emerging markets. I am comfortable with that based on looking at people like GMO who came into the last meeting, who came into the last meeting and talked about emerging. But I do think it would be helpful for trustees to see some valuation metrics from you all, to understand whether this is a good time. This is a short-term policy mix. It's not a 30-year policy mix. So how should we think about some of these asset classes that are being recommended? I know we have an opportunistic presentation coming up, but just within equities, if you can help with that.
Yeah, all of the asset categories, all of the asset categories that we're adding to, we believe are more attractively valued over the long term. And then over the short term, I think the only one that you could potentially argue is closer to some type of full valuation or would be TIPS, because they've traded a little bit rich this year. So that's the only one I would say that has maybe moved below an average in terms of
Adios.
What about the trade-off between emerging market debt and emerging markets equity in terms of valuation? I see you have emerging markets debt in the 35% basket clause scenario. Perhaps in thinking about near-term valuations, should we perhaps be doing that now and not increasing emerging market equity? Can you talk about that from a valuation perspective as well?
The decision there was really based on what leverage you have that you can pull now, that you have the emerging equity in place.
For the basket clause.
For the basket clause versus what you would need to presumably do an RFP, scope out an RFP, and then start that process either in advance of approving a policy like Mix G or...
I'm sorry, I can't see you, so...
Okay, sorry. So...
Either in advance of approval.
A policy like Mix G or even concurrent with a decision to move to Mix G. So I agree with you. I think where you're going is we're increasing emerging our exposure by 3.5. Could we potentially have a better mix of the two, either by putting all of that 3.5 in emerging debt or some part of it in emerging debt? And I guess I would agree with that philosophy, but we don't have emerging debt managers that we can give money to, and it may be at least a year before we could do something like that, given that we've got global REITs on the plate, emerging equities where we're doing our RFP to renew those managers and seek additional capacity, and then I'm sure I'm forgetting one or two other RFPs we have that we have to get done by this time next year.
High yield.
High yield.
And bank loans.
Yeah, one of the problems with that, we're slowly going from asset allocation to tactical implementation. Somewhere we're crossing that line. Tactical moves.
Well, our question was about valuation.
We can come back on the valuation. And it just intersected with what we did the last meeting, which is approve an expansion of corpus, because we're basically maxed out on people. Right? So that
you told us earlier that high yield looks pretty expensive today.
very expensive.
And then here's emerging debt that looks like it's a better value. So
Right.
why focus on a high yield RFP in an area that's fully
Well,
valued
if you back up, first we're focused on opportunistic fixed income.
Right.
Right.
First
So that
we're focused on
opportunistic fixed income. The contracts expire for high yield. In the ordinary course of business, I wouldn't be worried about high yield. But all of our managers' contracts expire.
Can we extend them a year?
We can, but we would like to use the new process to search for the high yield managers. And once we have that in place, we can talk about valuations and how we want to implement that, but we would have a list of managers available to us.
We also want to have an RFP for bank loans. We don't have a bank loans, which is floating rate, which if you think rates are going to go up, which we do, you need to have some floating rate exposure. We have none. So we have lots of opportunities to do lots of things. What we don't have is lots of people or time. So we have this window that we just opened on Thursday for this innovative procurement process. And the question is, how much can you run through that window before it closes? It's a very finite period of time. The time is 8 months after you file the first contract. And that's all there is. So during that 8 months, during that period, and I assume it'll take us 4 months, 5 months for emerging markets? 5 months. So we have a 13-month period to do as much as possible to impact the existing managers without implementing what I'll call new asset classes. We could, but it's pretty dicey as it is, while we're trying to hire some people and increase the staff and the capacity.
Could we though still urge reconsideration of redoing high yield if we are, from a valuation perspective? I'd love to see how to think about high yield versus emerging market debt, but emerging market debt has the real diversifying potential, and I just urge you one more time to.
Yeah. As you know, I think high yield debt is overvalued. So.
And our managers are fine. I've never thought there was a problem with our managers, so it's more fewer dollars and extend by a year and use.
Yeah, we could look at that. We could look at sliding it in.
No, not to create more work, to actually just say.
No. It's good. We had a different sequence in mind, but again, I'm very down on high yield. In fact, one of the things I'd like to talk about in a future session is we have an allocation, we have a band. It might be useful to go through the band in high yield, for instance.
So why 5% then? Why is high yield?
Well, longer term, it makes sense. These are markets,
No,
right?
but I don't think of this as a long-term allocation. We've sort of talked about coming back every year, every 2 years to do an asset. We don't want to wait another 5 or 7 years.
Right. Doug Mosley again, sorry. I'm new to this TV thing.
It's all right, you're talking the wrong one.
When you talk about valuation, you can look at an individual asset class versus its history, but you're also doing the relative valuation work. And so with high yield, we reduced it by 1.5%, but when it comes to being, rich or cheap or attractive, we have to also look at where else we put the money. So in the core plus 5 space, we also see that as relatively unattractive. So I think there's.
Hence our emerging market debt sort of,
Right.
Bringing that into the conversation to just say it is diversifying, it is not company risk, it's not company risk.
Right, and so the other issue is the high yield has a much smaller impact on the basket. The EMD is completely hitting the basket. So that's, we reduce, for every percent, I think we're doing 10% of the high yield is considered to be basket because of.
We're allowed 10% according to the statute in high yield. Some high yield goes in the basket. We've written our guidelines to minimize that. EMD, if it's local currency, would be basket. If it's not local currency, it depends on the particular security by security.
There's a couple of things that cut across here, and I want to take you up on something you said. The key, what comes out, and what Martin just said, is we need to change the basket. And that, I think, is market. It's not dependent on any markets. This asset allocation, as much as I might think, and you might think it's sort of a shorter term thing, if the markets blew apart again, we'd have this asset allocation, right? So we may or may not have new asset classes. I think this is an asset allocation for 24 months, let's say. And in those 24 months, you redo the basket. If 08 came back tomorrow, we still have this asset allocation. It might not be 24 months, it might be longer, unless we all want to revisit the asset allocation, in which case you might say, wait a minute, asset allocations are longer term things. You're not supposed to change your allocation based on the markets.
So philosophically, Gary, I would say that as a trustee, I would love to see asset allocation be a topic once a year on a full-fledged basis. whether we do anything or not. And if not more frequently, should there be a complete dislocation? I think we should not be wedded to a calendar for asset allocation. To me, if there's a huge dislocation where suddenly the portfolio, the same bets in the portfolio got a whole lot riskier, that is a time to think about whether we have the right short-term portfolio. What it doesn't change for me is the long-term portfolio, which conversation we will have in a few minutes. But this to me is a 1 year, 2 year, you pick, but it's certainly a topic that needs to be revisited every year and visited strongly in a major dislocation.
I agree.
The
reason we have it in the monthlies, we keep track of it monthly, is to focus on it monthly. And I believe that we'll continue to have trustee education and asset allocation on a regular basis.
Can I just say that if you shifted the mixes to more realistic investment-driven mixes, meaning opportunistic and hedge funds are just not going to get to 5% over the next year, you don't have this basket clause issue with
I'm sorry, you don't have
the basket clause issue, because you could take, I don't know, Seema and Martin have to tell us, but you know, the 5 becomes 3, and suddenly you've, in both of those, and you've freed up 4%.
in both of those.
Asset classes, and you freed up 4% in the basket clause. So I think some of this comes from our having gone to our intermediate target in asset classes that we just can't get to with process, governance, staffing, etc. So if we just make that what it's going to be, I think there is room. Looks to me like there is room. So
It looks to me
like there is room. Anyway, enough. I've said enough on that. I just urge you all to go back and rethink that. I think it may be a little easier than we might think.
Well, great, well, thank you. I think then at this point, what we would like to do is then bring back an interim asset allocation for you to actually vote on at this point, since since D, though it bumps up a little bit close to that 25% basket. And we would, I think when we come back with that also, in our presentation, talk a little bit more about the valuations of what we think are attractive and not, just so that we're all... Valuations of the asset classes, so that everybody is comfortable on the direction we are going and why we're going, and what at least our viewpoint is on these sub-asset classes.
If I can just expand on that, I think we probably ought to have a session on emerging market debt so that we all as trustees understand what it is, because we've never talked about it. And that'll help with the emerging market equity conversation as well.
And if I might observe, the investment policy statement, the big picture asset allocation is your strategy. It's the big picture, and yes, at any given time, various asset classes will appear to be out of sync. I think once you do that, though, that is an issue of dealing with things within ranges around the long-term targets, for which you should then think of it more as a tactic. And as a tactic, you ought to determine who decides, how much, and then how you measure them. If somebody's going to move off the asset allocation set by the board, then I think there ought to just be some kind of a process. Because to me, that's not strategy. That's a tactical decision, and I think some good ones are being made. But that doesn't necessarily mean that they should go unnoted and unmeasured. And so just in writing up the strategy, I would encourage that the investment policy statement and the strategy be kept as such with specific targets by asset class. A thorough discussion of the bands around those, the ranges, be established. And then if there's a decision to either move around within the ranges, other than through market fluctuation, and or through even penetrating the ranges, that that be recognized as tactics, and that there be something in place to measure, provide somebody the authority, and then have some measurement of how well it's being done. And I think those would both be very valuable to the board in terms of managing the fund.
Yes, we are. So those are the, we'll also note that, but that is essentially our presentation, unless there are any questions. So we'll be coming back with more information.
So why don't we just table the long-term conversation for after that? We really want to get the short-term thing figured out first. Does that make sense? I didn't hear that well. I proposed at one point a long-term policy conversation, but I really think we should, I'm looking at our consultants, I'm saying potentially we should probably come back and fine-tune the short-term first, and once we have that, shift to how we might approach a long-term policy portfolio. Although you already have a lot of stuff in here on it, we can come back and revisit.
Yeah, I think that's right.
Okay.
Okay, any more questions?
So that ends our minutes for the public session.
Okay, then, there are no other questions about this. We need a motion to move out of the public session into the executive session.
So moved.
Second.
I'm sorry, who moved?
Ranjit, then Bob.
Robin Straub, second.
Any objections? Hearing none, the motion carries. We're now in executive session.